Good Saturday morning to you, and thanks for joining us today and on the Wealth Guardians radio show, the show that will tell you what you, not what you want to hear, but what you need to hear. I'm your host, I'm Doug Ray, and I appreciate you spending some of your weekend with us today. JB's with me this morning, and JB, how's it going, man?
It's going great. Good morning.
Golly, JB, can you believe it's almost the end of the year? Football season's coming to a close.
I know that I don't want to think about that, but I do want to think about the holidays. But yeah, I love my football this time of year. But you know, as you get older, it's such a cliche, Doug, but it does really just fly by. It
does, and I remember years ago telling my boys when they were little that once Halloween gets here, man, Christmas is right around the corner, and they say, "Oh no, Daddy, it can't be. It's just so slow." And I said, "No, son, it's going to fly by.
It's unbelievable. It's going quick."
It is. Okay, so again, everybody, welcome to the show. Again, before we get started, I just want to extend our thanks and gratitude to all of our men and women who are in the armed forces and, of course, our first responders. Thank you so much. You are always in our thoughts. All right, so again, JB and I look forward to spending the next 30 minutes with you.
Well, welcome to the show once again. And Doug, like you said just a moment ago, it's December. I mean, the year is coming to a close, and boy, it has gone by in a hurry. You know, I got to tell you, I had some time to catch up some reading over the Thanksgiving holiday, and I read an article about the stock market and how it routinely has a positive bias going into the holidays. And I was thinking, really? I mean, you could have fooled me this year. I mean, Doug, am I wrong? But you know actually more about this, but it seems to me that the stock market has been throwing a temper tantrum all year, and especially here currently, it's crazy out there. What's going on?
Well, yeah, JB, I'm glad you're reading stuff about the stock market. I'm glad to see that. That's good on you. Mm-hmm. So anyway, but yeah, I mean, golly, volatility is back with a vengeance.
It is.
You know, folks were kind of lulled into sort of a sleep after the 2016 election. And,
right.
You know, the market, it just went up and up and up without so much as even a 5% correction. And, you know, when new folks come in to see us, I ask a lot of questions, but one question I always ask is, what do you think is a reasonable rate of return for your money? And I got to tell you, in the last, year or 18 months or so, I've been getting crazy numbers like 10 and 12%. When 3 or 4 years ago, people would say, 3, 4, 5%. Mm-hmm. You know, JB, 10 and 12% returns are not normal.
Right.
They are abnormal.
That's correct.
Returns.
Yeah.
And folks just can't expect that to happen year after year. So what's going on? Well, let's rewind back to February. That's when this mess got started, and it got started with the talk of trade wars. You know, by the end of March, our stock market was down about 12%. Then we started this nice little recovery, taking us up. By the end of September, we'd recovered that 12% loss. In fact, we even made new highs. The S&P 500 got up to 2940, thereabouts. Then October hit. Mm-hmm. Whoa. Katie, bar the door. Look out below. By the end of October, we were down 12%. So a bit of a recovery took place from the 1st of November into the midterm elections. And then we started giving it all back again. A lot of technical damage has been done. Now, from past shows, I'm a technician.
Right.
I love watching the charts and everything. And so let me just, from a technical basis, and we'll talk fundamentals in a minute too, but from a technical basis, let me just kind of tell you where we are right now.
Okay.
We're under the 200-day moving average. Our relative strength is now below 50. And, from my previous conversations with you folks, I really watched that quite a bit. Dr. Schaap told me this years ago, the 50-50. In a market uptrend, you need to be above the 50-day moving average, 50-week moving average, and RSI needs to be above 50. Well, we're below that. We are firmly in correction territory. Mm-hmm. But Europe and China is even worse. They're in a bear market, a full-fledged bear market. And I'm afraid, JB, that folks are going to be in a bit of a shock when they get their November statements here in the next week or so.
Well, Doug, let me jump in here and ask you. I mean, basically, is the party over?
Well, it could be. We are way overdue for a bear market.
Right.
By about 2 years overdue. Mm-hmm. But, JB, I got to tell you, my crystal ball is about as foggy as yours is.
Yeah, it is.
I believe this stock market was given a new life after the 2016 election because it was looking forward to Trump's administration's policies on taxes and deregulation, and we clearly got that.
Right.
This year the market's been fighting a lot of headwinds. That midterm election was, it was a doozy.
Yeah.
We've been fighting interest rates, tariffs, and so forth. And, Fed Chairman Jay Powell, he has been raising interest rates like crazy. That's never good for the stock market.
Right.
And bottom line is what's been going on since really the last 2 years. He's been drawing about $80 billion a month out of the economy. Mm-hmm. Now, do some simple math. 80 billion, and I said B with a billion.
With a B.
Yeah, not a million. B. Do some simple math. Times 12, that's what, 960 billion?
Billion, yep.
Are we talking almost a trillion?
Yep.
All right. So I don't know about you, but I don't thumb through $1 trillion in a year. And $1 trillion, it's kind of hard to wrap my brain around what $1 trillion is like.
Right. I think a lot of people do.
So let me give you an idea. Let me give you a reference point.
Okay, that's good.
So our entire military, I'm talking about the Army, the Navy, the Air Force, the Coast Guard, our Jarhead Marines, all of them, the ships that they float, the submarines that they float under the water with, the airplanes that they drive through the sky, all the battalions, all the rifles, all the tanks. That budget, all of that, is $700 billion a year. 3/4 of what Fed Chairman Powell has been taking out of the economy. Now, that's a lot.
Yeah.
No wonder housing is off.
Right.
We just got a good GDP report for the third quarter, 3.5%, but that doesn't, that's like driving looking through the rearview mirror.
Yeah.
That's not really we can expect going forward. So no wonder, the market is having trouble. But then there's this old Wall Street adage. It says a bull market needs a wall of worry to climb. Boy, do we have plenty to worry about. So, folks, I want to show you something you can do now to protect yourself. Working with us is quite simple. You just schedule an appointment and come in for a listening session, and then we create a custom plan and implement it when you're ready. That simple. And before you leave our final meeting, you'll know exactly how to preserve your retirement income. Most people are worried because they don't have a specific plan to turn to during their retirement. Turning to putting savings that they've built their life on into monthly income once they retire and aren't drawing that paycheck anymore. We create a written plan that does just that so you can relax and live the retirement lifestyle you've always dreamt of. We know how scary it can be to retire and leave that paycheck behind. That's why I have focused my practice and education on retirement income, and we have helped hundreds of families create retirement income for life. So give us a call at 336-391-3409.
Well, Doug, let's get back into our conversation before you mentioned the wall of worry. Is there any more to the wall of worry?
Yeah, JB, unfortunately, it is. We talked technicals a moment ago, so let's go ahead and jump into some fundamentals.
Okay.
Let's look at some of these ugly economic reports. Existing home sales had their largest annual decline since 2014 back in October. It was down 5.1% from the year earlier. And further, the University of Michigan, which does that Consumer Sentiment Index, that decreased in November from October by over a whole percentage point. And durable goods, those orders fell by a whopping 4.4% in October from September. That's the biggest monthly decline since July of 2017. And durable goods have declined in 3 of the last 4 months. The Labor Department reported unemployment claims applications rose last week to their highest level since June of this year, up 3,000 to 224,000. 70% of all jobs are created by small businesses, not large corporations. So, yeah, fundamentally, we have this wall of worry to go through. You know, the fact of the matter is the Fed continues to take liquidity out of the economy. And I got to tell you, you know, the president's been tweeting about this for some time now, and I don't think he's wrong about it. I mean, you know, for a long time, we had next to nothing in terms of interest rates. And, you know, what they're trying to do, what I think the Fed is really trying to do is get back to some kind of a normalized interest rate policy. But a lot of times the Fed can overreact. And I'm afraid we're starting to see some signs of that overreaction. You know, the Fed has created in the past recessions and even depressions. Mm-hmm. They created the depression, the 1929, the Great Depression, as we talk about. So, yeah, it's been tough.
Okay, Doug. Well, do you have any good news to share? I mean, you know, it is Saturday in December. Christmas is around the corner.
Well, yeah, there is some good news. And, you know, in all seriousness, I do have a glimmer of hope. But looks like I'm not going to be able to share that with you until we come back from break.
Well, I tell you what, let's take a quick break. We do want to remind you, you are listening to the Wealth Guardians radio show here on 94.5 WPTI. We appreciate you being with us. Remember, you can call Doug 336-391-3409 or visit the website at thewealthguardians.com. We're up against a quick break, but stay tuned as Doug promises to give us some good news about the markets when we come back. Stay with us, folks. Welcome back to the Wealth Guardians radio show, where we tell you not what you want to hear, but what you need to hear. Right in the middle of our very important show, talking about the economy and the markets. And Doug is promising us some good news. So let's continue with that good news, Doug.
Yeah, sometimes that need to hear is pretty rough.
It is. You know, a little tough love every now and then.
Yeah, you know, JB, during the break, I was thinking to myself, yeah, man, that first segment, that was like Dougie Downer time.
Yeah, Dougie Downer. Now let's do some Dougie Uppers.
All right. Let's see what I can do here.
All right.
So we started the first segment out with some technical information, and it was pretty nasty. Mm-hmm. Charts are ugly, no doubt about it. But here is a glimmer of hope.
Good.
So what I did, I brought into the studio today a chart of the Dow. It's a yearly chart. And actually, it's a 2-year chart. But here's the thing, you know, it has been an extremely volatile year. Most of you are not going to make any money in the market this year.
Right.
But what I have done is I have looked at the lows this year. And if you take your ruler out, a straight edge, and you just draw a line where all the lows are on the chart, mm-hmm. It's still an upward trending line.
That's good.
That's good news.
That is.
You know, what that means is we are making lows, but they are higher than the previous low. Mm-hmm. That means we still have some momentum in the market. Now, what's going to concern me a lot is if we break below that straight line. Mm-hmm. And we're close right now, unfortunately. Right. But again, you know, Christmas has always typically been a very positive time of year. And I've got a lot of hope that this is going to be. I mean, everything indicates that this is going to be the best Christmas we've had in maybe a dozen or more years.
Wow, that'd be great.
I mean, the numbers out from Black Friday and what do they call that Cyber thing?
Cyber Monday.
Cyber Monday. They were fabulous. I think Cyber Monday was the best.
It was.
Cyber Monday on record.
Right.
So yeah. So let's also talk about some more good news.
Okay.
You know, there really was a deficit of cheerful news around American politics the last several months. But there is a tidbit of mildly comforting and interesting information. And I was reading this article from Ned Davis Research, and I know most of you don't know who he is, but he's been a long time statistician and analytical person. And the bottom line is this. They did some work about midterm elections.
Okay.
And they said since 1946, in years with midterm election, the S&P 500 stock index has gained a median of 18.4% in the 9th-month period from September 30th. So what he's saying is this. He is saying that, yes, midterm elections have always been volatile years.
Right.
You know, the market hates indecision. It hates not knowing what's going to happen. But he's also saying they went back and they looked at the year after a midterm election, and 90% of them were positive, with most of those 90% being on average up 18.4%. Now, that bodes well for 2019.
Right.
And you know, we've elected this midterm election a split Congress. We have the Republicans controlling the Senate, and now the Democrats are controlling the House. One would logically think that that's not good for the market.
Right.
But here's the thing. Interestingly, the markets perform very well when we have a split Congress.
Is that right?
You know why? Because they can't get anything done. They can't screw it up any more than it already is.
So what you're saying, take the government out of it and the politics out of it.
Yeah. So,
wow.
You got one house offsetting the other house, and
Right.
you got a president who's pro-economy. So I take that as a positive going forward,
That's an interesting stat, though.
Yeah, it absolutely is an interesting stat, and, one that I hang my hat on. So we'll see. So again, I just want to let you know that, working with us is a simple task. It really is. You just schedule an appointment and you come in, we sit down, we talk and we listen, and then we create a custom plan that you can implement. And you can implement it when you're ready. You don't have to do it right then and there. Before our final meeting, you're going to know exactly how to preserve your retirement income. And that's something that I've found in 20 years with working with retirees is, they're elated when they first find out that they can retire. But then as they get closer to that day, the day that they walk out of the office or the plant for that last time, they get really apprehensive because there's no more paychecks.
Yep.
So that's what we do. We create a paycheck for you. Sometimes I like to call them play checks. That's just going to last you and your spouse the rest of your life. And it's in writing. You can see it.
Right.
So just give us a call at 336-391-3409. So I've given you guys some glimmer of hope, something to hang your hat on for next year. But we cannot change the economies and the markets. There is a bear market out there somewhere. It's going to be big, bad, and nasty. In my business, we call it a regression to the mean. We've had a massive run up, not just since President Trump was elected in 2016, but I'm talking about going back all the way to the last bear market recovery, back to March of 2009. It has been huge. Markets don't go up like that all the time. They will eventually normalize, which is called the regression to the mean. So to get back to the average or the mean, we have to have a really nasty downturn. And that's where retirees, pre-retirees can find themselves in a world of hurt. If you go through a 2008 market again, either during retirement or just before retirement, without some sort of protection, the likelihood is quite high that your retirement's not going to be what you think it's going to be. You know, I look back at 2008, and I even look back at 2000 to 2002. You know, I've been in the business 30 years, and the last 20 years I've specifically worked with retirees. And I can tell you, people who came to me during that period of time who had just retired or were on the verge of retirement, who believed in buy and hold and letting the market take their monies up and down and up and down and up and down, they were significantly hurt. And that's why our practice over the years has developed circuit breakers, if you will. You know, we have measures to control downside volatility. In fact, we design a portfolio, retirement portfolio, that if you measure it against, say, a 2008 market where the S&P was down 50%, our portfolio is going to be down between 5 and 10%. Now, a 10% downturn, you can recover from that as a retiree without even any more paychecks, because all you have to do is get an 11% return. If you let your monies go down 50%, you have got to get a 100% return. If the markets average 8% a year, how long is it going to take you to get 100% return? And that's if all your money is in the stock market. Most portfolios are not. There's some kind of a mixture of, say, 50-60% stocks and the rest fixed income or bonds. So if you're getting, say, 5-6% a year and you've got to get 100% return, you're looking compounded probably 16, 17 years to get it back. That's not doable.
Right.
You know, if your retirement dreams are built around travel, because I hear that a lot. You know, I ask people, what are your goals when you want to retire? Travel is like number one.
Right.
Being with the grandkids, all of that. And I get it. As a grandparent, I absolutely get it.
Right.
You know, there's nothing better than that. But if you suffer that kind of loss, you're not going to do that European river cruise. You probably won't even be able to go to High Rock Lake. No, I'm joking there. You can probably go to High Rock Lake. But, you know, with the technology that we have today, there is absolutely no reason whatsoever that you should experience another 2008. None. And here's the other thing. This is like the double-barreled shotgun you're staring down. Not only is there a bear market in stocks ahead of you, we're already in a bear market in bonds. And what do I mean by that? Interest rates have been going up since summer of 2016, right before the election. And that all occurred around when Britain decided to exit from the European Union. If we look at our 10-year Treasury bond as a benchmark, which it is, right after Brexit, that thing hit like the interest on that was like 0.75%. Okay? Today it's over 3%. That's a huge move. Let me give you something to measure that with. If you bought a $1,000 10-year Treasury bond back then, today it's only going to be worth about $700 if you had to sell it on the open market. That's a 30% hit. So what am I talking about? I'm talking about most Wall Street portfolios for retirees are built around an allocation mix of 60% stocks, 40% bonds, with the idea that bonds are going to kind of dampen down any stock market downturn. Well, not now. Not with interest rates going up. And as we said before, the Fed has been raising rates. So I guess here's the thing. If you are a pre-retiree or a retiree and you sit there looking at your portfolio this week or next week, looking at your statement, and you see your money is down, come and get a second opinion. If you are really sick and you need an operation and the doctor said you need an appendectomy or whatever it is, wouldn't you get a second opinion?
Sure.
Most people would. So why not look at your monies and your future retirement and get that second opinion? It's only going to cost you a little bit of time sitting with me, and we don't bite in our office. I promise you that. We'll even give you a cup of coffee. give us a call at 336-391-3409. Folks, that's about it for this show, and I appreciate you spending some time with us this Saturday, so I'll let you get back to the ball games, and we'll see you next week.
The information provided is for educational purposes only and not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Wealth Guardians and do not necessarily represent the views of the Alpha Star Capital Management. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Any comments regarding safe and secure investments and guaranteed income refer only to fixed insurance products offered by Wealth Guardians. They do not refer in any way to securities or investment advisory products. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, a registered investment advisor. Alpha Star and Wealth Guardians are independent entities.